Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. With the cash trade just an hour away, here's what you need to know. Asian stocks track Wall Street lower as strong US business data spurs bets on the Fed holding interest rates until at least December. We'll speak to William de Vijlder, Group Chief Economist at BNP Paribas. As the UK election campaign kicks off, consumer confidence improves for a second consecutive month after inflation drops. We will bring you retail sales data from the UK shortly. Plus, we're live at the G7 finance meeting in Italy, where Ukraine's allies are wrestling over a deal to use frozen Russian assets to support Kyiv. We will speak with the European Economy Commissioner Paolo Gentilonni and Bundesbank President Joachim Nagel later today.
A quick check on these markets here. When you're looking at the futures action, you are seeing a notable shift in sentiment. Euro Stoxx 50 futures and FTSE 100 futures on the back foot and by a big margin. The two-year yield as well nearing that 5% level, 4.92. We're going to dive into the U.S. data. And, of course, euro dollar 108.12. Markets today starts right now.
Friday the 24th. Good morning, folks. So we asked a question yesterday, which was going to be more important, Nvidia or the Fed? It turns out probably it is the latter. Nvidia is now bigger than the entire German stock market, but it's not big enough to lift the US market. Yesterday, it was the data that really put paid to the rally that we've seen, and we come significantly lower, and we're lower here in Europe this morning. We saw the PMI data, we saw the claims data, all of that adding to this feeling that the US economy is on a tear, and the Fed is going to have to be more hawkish as a result of that. So the question you've really got to ask yourself this Friday morning is, given all of that, given where we are right now with a long weekend coming up in the United States, it's Memorial Day, Monday, and a bank holiday here in the UK, are you really prepared to buy the dip this Friday? I think that's going to be on a lot of people's minds this morning. What's also on people's minds this morning is whether or not Anna has been shopping.
Well, have you noticed, Guy, it's been a bit wet? And I think that's relevant because that takes us into the retail sales numbers, and they are weak. We are down by 2 points. If you're looking at including auto fuels month on month, we're down by 2.3%. The estimate was for this to drop by just 0.5%. If you exclude fuel, similar picture, down 2%. Expectation was minus 0.8%. So this is a weak set of data. It has been wet, and that was the sort of headline hanging over the expectation.
Rishi Sunak knows this.
Rishi Sunak does know this. Yes, he has experienced this firsthand. So we all carry our umbrellas just in case. Consumer confidence, though, told a different story, didn't it? We got that data out from the UK just overnight, and that was up for the second month. Really, that painting the same picture as the conversation we had yesterday with Ipsos about improved net pessimism in the UK, but more pessimism on display this morning, perhaps weather-related.
It's so funny how the weather here, at least, when it's always raining, impacts the mood. You think people will get used to it by now.
You've only been here for like 6 months, and so you're completely excused for thinking that it's always raining, because that has been the 23-24 phenomenon.
Everyone has told me that the summer is where everything happens. I have to be in London for the summer.
Well, it might rain then as well.
And then we'll have another retail sales conversation. We should also mention there's redhead crossing the terminal as well, that the UK energy price cap will drop out 7% in July as well. So that's going to feed into perhaps the consumer story, especially ahead of the election.
So we need to frame this all in the context of the election. The consumer does seem to be feeling better. Certainly, you've got real wages are starting to improve quite significantly. Maybe we don't want to go shopping because we don't know what to wear because the weather's so bad. But the consumer confidence data is interesting in the light of the timing around the election. And I just wonder whether this uptrend is going to ultimately end up mattering.
Yeah.
The off-gem story, I think, is interesting. The other trend I would point out this week is the fact that gas prices have been up 14% this week, and that continues another trend. Is this as good as it gets when it comes to energy prices?
And so we'll keep our eye on commodities. We have a commodities guest later on. Let's get back to the markets, Dura. You set this up very nicely, not just now, Guy, but also yesterday, asking this question about whether it would be the Fed or Nvidia that guided sentiment. I mean, for the overall markets, you're right, it was the Fed. And Nvidia stood out, didn't it? But as a kind of a sore thumb yesterday. I mean, it was up by, 9% in session, making incredible gains, adding $218 billion of market value. But that wasn't the overall story for the markets yesterday. That was very much more about reassessing once again Fed expectations, and just one hike now, December.
Yeah, and the stock market, it kind of feels like that's almost the catch-up trade that Europe is doing this morning. At least when you look at the futures trade, you see optimism in the States and the futures contracts, but then here in Europe, it's a very, very pessimistic outlook in the futures action. I think the Euro Stoxx 50 is down like 0.7% or something. The bond market was interesting to me, though. 4.92 on the 2-year. The 10-year still below 4.5%. This bond market is going nowhere. Why is it so sanguine? Why is it so Why is it shrugging its shoulders?
So it's interesting. The curve has flattened quite significantly, and you almost wonder whether we're in a position now where the front end has come up and we've got this flat curve. But you do wonder, given the supply that's coming through and what is happening in terms of the deficit story and other factors, and in the election coming up, whether actually it's the back end that now moves higher and we end up with a re-steepening trade. I think that's going to be really interesting for the bond market to watch. That kind of bear steepening trade is something that nobody really has expected and talked about.
We've got PCE next week, and that will be really important to watch, given the inflation focus, of course, and that'll weigh in on our rethinking, and the bond market will be observing that very closely as well. So we look for PCE and all of that coming at a time where we're hearing a lot from the Fed about how the transmission mechanism works. And Bostic was really interesting on that. We'll get into that later in the programme.
Well, and then that all connects to kind of the back end of the curve that Guy was just talking about as well, because that is the Fed's worst nightmare, right? They see some sort of volatility or some sort of steepening in the 30-year, for example, similar to what we saw in the third quarter of last year. And that really freaked out not just the U.S. bond market of the Fed, but it was mentioned in the BOE, the ECB, even the BOJ said, this is a problem that's actually affecting, and that's just the monetary story. Then we have to go into the fiscal on both sides of the Atlantic.
Can I just say that Ollie Crook's got the best gig today?
Yeah, he's bird noise in the background as well, which
bird noise
I
in the
really
background.
appreciate.
He's at the G7 meeting. It looks absolutely
Did you notice he's wearing a tie?
I didn't. I haven't actually seen that yet this morning.
We look forward to seeing that shortly.
My campaign for no ties appears to be going in the wrong direction.
It does.
I've converted Ollie to my side.
We do know, back to the serious matter of what's on the agenda, though, we do know that Janet Yellen and Christine Lagarde are going to be meeting, and the two-speed economy could be in focus. You know, the two-speed global economy, the US really propping up the rest. And that's going to be really interesting to watch in the second half of this year, because the narrative about divergence has been strong up to this point. But then to what extent does, if the US, you know, if that resilience continues, to what extent does that lift other ships? Will be something to watch.
And it has for a little while, right? We kept talking about all these corporate CEOs, European CEOs that came onto our program and said it's the U.S. that's offsetting our exposure to Asia, for example, and the weakness there. But it almost seems like, to your point, that transmission mechanism is slowing a little bit. That fiscal spend that the U.S. kind of kept pumping into its economy, the ripple effects are a bit slower.
Let's see that time. Let's go to the G7 finance ministers meeting. Ollie Crook is standing by for us to update us on exactly what we should expect coming out of this meeting. Ollie, what is going to be the dominant theme here? We've kind of kicked around a number of different subjects. You've got this two-speed economy, this divergence across the Atlantic, this differing picture between the United States and the European economies. That is certainly going to be one subject. You've also got the Ukrainian issue as well, front and centre. Where do you think the focus is going to be?
Yeah, let's start with the Ukrainian issue, because I think that is really where we're going to be able to get concrete steps from the G7 finance ministers meeting as they are today and tomorrow, and really trying to figure out how to unleash the sort of monetary impact of those Russian assets being held across the world, but really concentrated in Europe. And really, you'll remember that the debate was the U.S. wanted to seize the assets. The Europeans were feeling a bit reticent about that. They wanted to just, give the profits from those assets over the years to come. But really, they seem to have coalesced on this idea of the future profits, so they could write one big check for, say, $50 billion and then say that the future assets, the future profits are going to pay for that. However, that is obviously a good idea in theory for these people, but the technicalities are a little bit more complicated, and that is where you're seeing some of the hiccup here, and that is what they need to work through. For example, let's say in 5 years' time there's a peace agreement, those future profits have been committed. Who will then have to backfill that huge quantity of money? These are some of the issues they need to work out, and really also at the same time showing unity as a G7 bloc. This is a key concern that Janet Yellen flagged yesterday, that really Putin is fighting a war of attrition. The G7 needs to show that it is there for Ukraine.
So this is the conversation around Russian assets, and this could add $50 billion, according to US estimates, to what they can provide to Kyiv. But I know there's been some German pushback on that, Ollie, and perhaps from other places around Europe as well. What about the other matter on the agenda that Guy referenced? We were talking about this two-speed economy idea. That looks as if it's going to be something that gets addressed at this G7.
Yeah, it certainly will. Obviously, the Fed and where it's headed is very different from where the European economy is headed. And it's something that actually Janet Yellen addressed yesterday while she was speaking just at the lakeside here, a couple feet away, saying that basically, yes, the U.S. economy is storming ahead, but really there is this huge question. Of course, Japan is here. There's a lot of questions about the effect on the economy, how they should interact. Will the sort of question of FX intervention come up? It probably will, because the journalists will be pushing it, but I think that it's something that the G7 don't really want to talk about so much in terms of the internal sort of disputes there. What's interesting, though, and we'll speak to Nagel a little bit later, the president of the Bundesbank. I mean, even in Europe, we have sort of some data that came in the face of the inflation narrative. I mean, that wage data, another record, up 4.7% in the first quarter. Could that derail where we see the numbers going within Europe? And will that sort of spark a debate for some of the central bankers that are here today?
Ollie, one of the conversations that keeps seeping up into a lot of the markets talks that we have is how you price in the elections, not just the UK election, and of course the parliamentary elections in Brussels as well, but specifically the US election, what the knock-on effect looks like in tariffs. It's something that people can't get their heads around. Is that even a conversation that's coming up in Italy right now?
Yeah, completely. I mean, it's really implied in the Ukraine conversation, right? Because the Congress has already passed that $60 billion package. The question is adding another $50 billion there from the Russian frozen assets. I mean, part of that realistically is to sort of Trump-proof funding for Ukraine into next year, right? So this hangs very large over this. And of course, it will hang large over the conversation around China and trade. China is not officially on the agenda in the communiques that we've gotten so far. But yesterday, Janet Yellen was saying we need to get on the same page, the G7, saying that, you know, we will not accept this overcapacity from China. And obviously, no matter who is elected, you have that China conversation looming over everything. One, because, of course, any kind of trade war or any steps towards that sort of thing will be inflationary. That'll be a problem for the central banks. But then the second, as the U.S. puts up more trade barriers for a lot of the goods coming from China, where are those goods going to go? They're going to come here to Europe because they're much slower at putting these trade barriers higher. So that's going to be a major concern for the central bankers and for the finance ministers here.
Ollie, as locations go, I think you're winning today. Ollie Crook at the G7 in Italy. Thank you very much indeed. We'll be back with Ollie a little bit later on. We've got many more interviews coming up out of the G7 today. Paolo Gentilonni, the European Economy Commission, is going to be joining us. Plus, as Ollie was mentioning, that exclusive conversation with Joachim Nagel. He is, of course, the Bundesbank president and ECB Governing Council member. Got the final GDP prints out of Germany today, pretty much in line with expectations. What else have we got on the agenda?
Let's have a quick look, shall we? G7 finance ministers then. We've been through that with Ollie. 1:30 UK time, we get US durable goods data. We have a number of AGMs taking place today. Total Energies, Mundi, a couple of the ones that stand out. Nigerian GDP in focus. Central bank speakers, we'll hear from Schnabel, from Jordan and from Waller. And sovereign rating updates. I mean, there are a few things to look at there, but I think, yeah, we're looking ahead to next week and some data there, aren't we? PCE as well.
Well, let's look at what else we're going to get into the rest of the program. Coming up, copper set for its biggest weekly loss in more than 3 months as the metals rally eases amid a stronger U.S. dollar and weak demand coming out of China. We're going to dig deeper into the commodity story. Max Layton of Citigroup joins us later in the program. Plus, SpaceX weighs a plan to sell existing shares at a price that may value the company at roughly $200 billion. We're going to get into the details. Turns out it's a little bit more complicated than you think to invest. Of course, if you have any questions of your own for our guests or even to us, be a part of the conversation. Just type in IB plus BBTV Go on your Bloomberg terminal. This is Bloomberg.
South Africa's most important election since the end of apartheid focuses on infrastructure challenges, economic growth, and political fragmentation. Bloomberg's Jennifer Zabasaja reports live from key battlegrounds in Johannesburg, Cape Town, and Durban.
We think that South Africa is an exciting part of the world.
South Africa is a thriving and vibrant democracy.
There's a lot of expectation for the election.
Coverage begins May 27th on Bloomberg Television. Context changes everything.
If there's a rate cut, fine. If there's not, then it's the question of how companies then react to that. How do they then build their businesses to exist in a rate environment which is higher than it has been the last 15 years? But I would argue that the last 15 years have been an abnormal rate environment.
Michael Roberts, HSBC's US and America's CEO, speaking to Bloomberg Television. His comments obviously come as we watch the data roll in, and it continues to be relatively strong. US PMI data for May. This is the services number and the manufacturing number, both surprising to the upside. That, again, spurring expectations that maybe the Fed does not deliver many rate cuts. We're down to 1 in terms of the pricing we've now got. That is for December. We appear to be heading in the direction of maybe no rate cuts in the United States this year. How does that change the global narrative. William de Vijlder, BNP Paribas Group Chief Economist, joins us now. William, great to see you this Friday. Look, we're in a situation where it appears increasingly that for 2024 we are pricing out rate cuts for the United States. We clearly have a two-speed economy. We've got a US economy and we've got a European economy. How does the fact that the US appears to be stuck, and it's a great problem to have in so many ways, with a very strong economy, how does that change the narrative, do you think, on our side of the Atlantic? How does that change the narrative for Europe?
Well, first of all, it's of course good news from a net exports perspective, because if US is doing fine, that gives more export opportunities for Europe. Some people will also refer that it may have an impact on the leeway that the ECB would have in terms of cutting its own interest rates. However, I would disagree with that. I think each central bank has its own mandate, own economic set of economic variables, and in the European, in the euro area, it is well wanted to start cutting rates in June, and then to pursue gradually. So I think the bigger impact is what is happening on bond yields, because there you see that, of course, US Treasury markets has a global influence.
Okay, so what does that mean? Okay, so that's kind of where I wanted to go. You've got a situation where US Treasuries look like they are going to remain, well, US Treasury yields are going to remain high. In that kind of a scenario, even with the ECB cutting rates, are we going to see the transmission mechanism being hindered by the fact that the US is going to be on a very different page? How much are we going to see that being passed through?
It will be more limited. Historically, when you look at the change in Treasury yields...
So, William, it's going to be more limited. That's okay. So talk me through the economic effect of it being more limited.
There will be an impact, but it will be more limited. So let me be very nuanced on that. I think the biggest impact of policy rate cuts by the ECB is that it will just give more confidence, and the ease of access to finance is going to improve. That is going to be the bigger impact. What you could call rate impact is going to be more limited, and that means that the pickup in credit growth, credit demand for financially constrained households, companies will be more slow. That is inevitable.
William, let's build on the U.S. side for a moment, if we can. The theme, or the continues to be, or the narrative continues to be, this kind of really strong consumer resilience. If you look at the commentary coming out of Jamie Dimon, David Solomon, for example, they're pointing to some of the earnings in kind of middle America, out of McDonald's, for example, AutoZone, where you are starting to see consumer behavior actually change. If we're talking about any element of fragility in the U.S. economy that could have ripple effects globally, where might that be?
That is the multi-million dollar and euro question. That is that households, they are not a homogeneous group, and you have already a pickup in delinquencies that has started admittedly from a very low level. So the key question that we are facing is that when that fragility would intensify, is this going to have a bigger impact throughout the economy? So the people that are better off, will they also start to become more concerned about the outlook? In that respect, it all comes back, I would say, to the labor market. The thing I'm concerned about is that you would have a kind of a belief developing that the economy is weakening if the hiring pace, which has come down quite significantly, would continue to go down. And that is why I think also the market is so sensitive to the initial unemployment claims, to the payroll data, to the hiring data, etc. So, but for the time being, it is incredibly resilient. So if you look at households on average, very resilient. They had locked-in fixed-rate mortgages. They have a part of the households are benefiting from higher interest rates because they are net positive in terms of financial assets. Net worth has gone up, etc. So it's very virtuous from that perspective.
It feels like that has a big wealth effect as well. When an average American is looking at their pension, for example, looking at the massive stock market gains, combined with the housing prices, obviously it's going to affect that consumer sentiment. But that in itself feels like the wealth effect is perhaps more magnified than it normally or historically has been. Would you agree with that?
Yeah, I must say I'm a bit skeptical on the power of wealth effects, but okay, it's clear that it has a positive influence on confidence if you see that your equity portfolio is doing well, and so on, does that force you to kind of go out and spend? Let's not forget that the excess savings have also run down. So it all comes back on what is going to be the growth of real income, and this then ties in with the wage growth, ties in with inflation, and ties in with the growth in people at work. So what you see is you have an economy that you could say it's really doing very well. It's very resilient. So why worry? Well, we worry because we do not know whether the weaker part of the economy is going to be hit big time, which would then have a kind of contagion effect to the rest of the economy. And for that to happen, if it were to happen, I think it will still take considerable time.
And William, what's the role of AI here? Because we talked a lot about NVIDIA this week, and we've, in some cases, been looking for this to show up in the macro. But yesterday we talked a lot about NVIDIA reducing the lag between the different iterations of its product, and it feels like this technology is coming really, really quite quickly. Does this show up in, where does this show up in the macro data? Does it show up in inflation? I heard Tom asking this question at the end of the last hour.
I think it will show up gradually and more importantly as a driver for CapEx. Let's not forget that U.S. companies have been investing big time in intangibles. That is a long-term trend. AI is only going to accelerate that. What I'm really interested in is whether every single company is going to be as agile. So I think in terms of differentiation, that is going to be a key factor. Of course, if you look at it from the equity market, if you look at it from a macroeconomic perspective, what you will see is that productivity should have a beneficial impact, of course, but these things are going to show up very gradually. I think with respect to your inflation question, it is more related to more granular, I would say. I would not make a link with the overall inflation numbers. It's more sector specific.
William, thanks. Thank you very much. Thanks for joining us, William de Vijlder, BNP Paribas Group's Chief Economist. Thank you for spending time with us this Friday. Yeah, really interesting. So many threads to the transmission mechanism right now. And we heard Bostic talking about this yesterday. Corporates had done a lot of hard work during the pandemic to refinance at really low interest rates. And so they came in to this hiking cycle in good shape. And William, was just talking there about households also being in fairly resilient form.
Yeah, it's interesting, though, because a lot of that work has been done on so many corporate balance sheets. And you saw that in Europe as well. You saw that in the United States, a lot of that kind of dealing with the debt issuance. By the way, maturity walls are coming up. That's a separate conversation. Now it feels like they're tackling the demand side. I'm going to bring up the McDonald's story really quickly, because when you looked at their earnings, McDonald's, PepsiCo, a lot of these kind of consumer-facing names, they're changing their pricing. Even Target, for example, price cuts in some of their goods. Yeah. Because they're worried about that demand abating. That's not something you're hearing from the likes of William, for example, who's talking about this resilience. It
feels like you've got this kind of K-shaped recovery, and it's how that K develops. Anna, I thought you asked the most interesting question there. It's about this inflation narrative. It's about this idea that America is investing in productive capacity. It's not, like, some of it's AI, a lot of it's AI, but it's all over the place. Yeah. And you're seeing this as a result of the IRA, the CHIPS Act. Everything is coming together to produce a more productive economy, and we're not seeing that here in Europe.
I mean, maybe that's back to basics of economics, where you've got monetary policy trying to tighten, and then fiscal policy with the IRA and similar policies. Yeah. But
the supply side of the economy looks like it's going to be better in the States post this story than we are seeing necessarily here in Europe.
Until the election comes around and border control and immigration all factors in.
That's all probably true. We'll talk more about what is happening here in the UK with our UK economy and the wet weather. We're going to be back to that in a minute. I'm sorry. This is Bloomberg.
Welcome back to Markets Today. 30 minutes from the start of today's trading session. Let's have a look at the futures picture. And the European futures story, it looks pretty negative, actually, this morning. We could see some fairly substantial move to the downside on the London market in particular, but overall down around 0.6%. The focus yesterday was very much on the Fed, a reassessment of whether we get any rate cuts. The market seems to be coalescing around one in December now. That's the Fed stateside narrative. How that flows into Europe, or continues to flow into Europe, is the question. US futures pretty flat, actually, this hour. Over to bond markets, and we talked a little about the action we saw yesterday in the States. Yields were higher, but maybe not as moved by the Fed conversation of late than maybe stocks have been. Waiting for PCE data next week, waiting for the UK bond markets to open today to see how they digest the conflicting data we've had out on the UK around consumer confidence and retail sales. Let's delve further into that UK story. The pound hit a one-week low shortly after UK retail sales data for April came in well below estimates. Then I think it bounced back again. Let's get some analysis of what we make of all this overnight news flow. Dan Hansen joins us, Chief UK Economist at Bloomberg Economics. Dan, good morning to you. So we got some fairly resilient consumer confidence data, improvements there, seem to, well, for 2 months, if that's solid enough. Then the retail sales number looked pretty weak, but I know it's been wet. So what did you take away from the overnight data?
Yeah, I always seem to come on and talk about the weather with you guys.
Excellent.
I mean, I think. Look, if we're gonna place most weight on one of those two indicators, it's going to be the consumer confidence stuff. So retail sales is extremely volatile month to month. I wouldn't be surprised to see a similar bounce back next month. I think what I'd say from the consumer confidence data is that obviously it's on the rise, and what we know about the consumer confidence index is that it rises when real incomes rise. And that's the big story this year for the UK. So we've got nominal wage growth well in excess of inflation. And I think, yeah, OK, we've had this fall in retail sales in April, but I think going forward, there is a pretty positive consumption story. And the other thing I play into that, and in the news this morning, is this drop in the off-gen price cap, the 7% drop in the off-gen price cap. That's going to keep inflation in and around 2%. And that's clearly a good news story when you're talking about this real income rise that we've got this year and the consumption story.
I would note on that, gas prices have been rising quite sharply recently. I wonder whether this is something that is going to be sustained in terms of what Ofgem delivers. But Dan, the big question, we're going into a general election. We've got, as you say, the consumer confidence story beginning to improve 2 months in a row, as Anna says. Is this something that can be sustained, i.e. through the summer, through that election period? Is the mood of the country improving at a fairly rapid clip here, and how sustainable is that?
Yeah, so I think you're right, guys. So, I mean, just very briefly on Ofgem, I think that prices will rise in October, probably not by a huge amount, but they will rise, again, household energy bills. To go to your question, I think there is this, what I would call a sweet spot, where things are looking relatively rosy in terms of the near-term economic data. Yeah, we've had the retail sales drop today, but I wouldn't place too much weight on that. I think the balance between what Sunak's narrative and where he is and Starmer's narrative is that Sunak's very much focused on this near-term story, these near-term good news GDP data, good news on inflation. Starmer is talking about what's happened over the whole Parliament, where we haven't had a rise in living standards here in the UK, so real incomes per capita at least are still below where they were at the start of the Parliament. So they're the two narratives that are conflicting. But if you're in sort of Sunak's camp, and to go to your question, there is, I think, probably a bit of a sweet spot here, and that probably goes to why he decided to sort of go for it and say let's go for it now and have the election sooner rather than later.
Dan, I'm curious about your thoughts on that report coming out of the IMF talking about £30 billion worth needed of savings. This is the same organization, of course, that 2 years ago predicted that the UK would take years to come out of a recession. Does that number sound right to you, more or less? Is that even achievable? Your thoughts?
Yeah, I mean, it's basically the poison chalice that's waiting the next government. What we know about the UK fiscal picture is that all of these tax cuts that have been announced, they've been based on unsustainable spending plans. And that's what the IMF's talking about, is that there are going to need to be these tax rises in order to keep public service provision at a level that the electorate would expect. So that number didn't come as a surprise to me at all. The IMF has been a bit gloomy on the UK economy, but it's not really about what it's saying about the economy. It's about what it's saying about what's needed to make public service provision sort of reasonable, if you like, with all these commitments that are on the NHS, defence and the like. All the other departments need a boost to spending to keep up with what's been going on with prices, and that's really where that £30 billion number comes from.
Dan, thanks very much. Dan Hansen, Chief UK Economist at Bloomberg Economics. Let's continue the UK focus and bring in Sam Onstead from Bloomberg's Markets Today blog.
the name of the
name
show.
right, and it's the name of the show. I do apologise. Now the name of the show is established and your blog. Let's talk about what's going on in the UK, shall we, Sam? I mean, we just heard there from Dan Hansen. He was talking about the economics of all of this. But to Guy's point, the comments we got from GfK around their consumer confidence data were interesting. They said this good result anticipates further growth. There does seem to be an expectation of better times in that, and that's really fascinating given politically where we are.
Yeah, so that consumer confidence data is always quite interesting, right? So it's often better to look under the hood. The headline number in there is almost always negative, right? I mean, you can say that's probably something to do with the British character.
We had this conversation yesterday with Ipsos.
What was the phrase that she used?
Net pessimist. And there was an improvement in net pessimism.
Yeah, because and that's kind of how you need to read that data, is that, you know, anything that's only marginally negative or is getting slightly better is actually pretty good. But underneath the surface, that's the more interesting part of it, is how people feel about personal finances, how they feel about savings. You know, we're seeing it's actually very similar, you know, in terms of big ticket deals, right? So this is something that we've been talking about a lot with consumers. They've been cutting back on spending on things that cost more money, but where they can cut back. So DIY, for example, we had Kingfisher results earlier this week. They're cutting back there. That's been the picture for quite a while now, and hasn't really altered all that much. So we're not really seeing it flow through particularly strongly within the results we're seeing. You know, the consumer confidence data is going up, but within the results of companies, we're not seeing a huge change.
How much is the rise in the living wage having an impact on this data? How big an impact will that have, not only in terms of the consumer confidence numbers, expectations of future financial health, and also ultimately the spending habits?
Yeah, I think it will have a reasonable effect, right? So I think you were just talking about Ofgem today as well, that coming too. That, in combination with the national living wage going higher, should see those numbers go up further and further. As I say, that top-line number, I doubt will go positive. I mean, it's still sort of minus 18.
Let's be realistic.
But it will continue to kind of to go up, and I think the national living wage will help with that.
Sam, we keep talking about this kind of assumption that the data is only going to get better from here. And to be fair, it has directionally. But month to month, it has been still a little bit volatile.
Yeah.
And Andrade over at Bloomberg Economics continues to make the point that the BOE is far more sensitive to each individual piece of data than some of its peers globally. How does that change? If you don't have this positive data the next couple of prints, what goes wrong?
Well, I think so. It's certainly retail sales data in particular is extremely volatile, right? So how much weight the BOE put onto that, I mean, I can't tell you, but I don't think it would be a huge amount, right? But I think over the course of the next couple of months, as Dan actually kind of alluded to, the retail sales data often here is almost like a backward-looking weather report, right? You go into the ONS data, and almost every single time it's like, if it's sunny, things have gone well, and if it's not, then they haven't. You know, and because most shopping is still done in stores, right? And people here apparently are really, really afraid of the rain.
Apart from Rishi Sunak.
But, you know, in terms of consumers, I think at the moment for the BOE, I think really for the BOE, the key thing, and it's going to remain the key thing throughout the rest of the year, and certainly in the next couple of prints, is all inflation and all services inflation.
I'm renaming retail sales index as the umbrella index. Then I think that's what we should consider it as. Let's move on to the politics a little and where that rubs up against finance and investment, because we've got a really interesting story out today that sort of sums up a fairly relaxed attitude from UK finance around the expectation that we get a Labour government.
Yeah, from the business community and actually from economists. So, you know, as when the election is announced, you get a huge number of notes coming through about what may or may not happen, you know, the gaming out various scenarios. The consensus is all around that actually, when you look at it, the difference between the two parties is not that big, right? So it's certainly in comparison to previous elections where you had a much larger choice between what policies you were going to take. For markets, it's very unlikely they're going to be anything in there that's going to particularly spook anyone. There could be, you know, over the course of, you never know what happens with an election campaign. But certainly for now, there's nothing in there. And also, you know, what happened under Liz Truss has meant that everyone is absolutely terrified of spooking the bond markets in anything like that kind of impact again.
I wonder whether if the election gets closer, whether or not the bond market starts to pay attention. It's going to be interesting whether that idea that actually consumer confidence is improving maybe changes the arithmetic when it comes to the polling numbers. Sam, thank you very much indeed. Sam Unstead from the Bloomberg Markets Today blog.
You did it.
Thank you very much. OK. I want to take you to sunnier climes. And while we're talking about the weather here, I want to talk about what's happening at the G7 in Italy. As you can see, actually maybe a little cloudier than maybe we would have first anticipated. But we're starting to, I think, gather for the finance minister's photograph. You're looking at live pictures coming to you from the G7. We will be back there shortly, I can assure you, with Ollie Crook, with some great guests that we're going to be lining up throughout the rest of the show. Anyway, we'll continue to monitor what is happening there. We'll get some good comments coming out from the G7. We'll leave you with pictures of that event.
Welcome back to Markets Today. 16 minutes until the start of cash equities trading that looks as if it's going to be weighed down by shifting expectations around the Fed. We are going to see some negativity at the start of trade. So the FTSE 100 could be a little weaker. And this all going back to, what was going to dominate the week. Well, it's the Fed conversation. It kind of came out of nowhere in a sense. I mean, we knew that we were going to get Fed minutes, but that turned out to be more relevant for the overall market picture than the AI excitement, which is there and evidence in the strength of the Nvidia share price.
It's really interesting. We kept going back to the macro versus the micro, and whether or not Nvidia is actually offsetting. Nvidia and its peers is offsetting perhaps some of the kind of more aggressive Fed tightening approaches. And there's a productivity question, there's an AI question, there's a stock market question to it that is completely separate from the chip story. And there's a macro read through. Yeah, absolutely. Let's get back to the macro. Let's talk to our Markets Live executive editor Mark Cudmore, who joins us now from Singapore. Mark, good morning to you. So it does seem as if the Fed story has been in the driving seat, despite the strength of the AI narrative and what we've seen from Nvidia. This is something that, I don't know, will it start to weigh more on stocks? Are we close to pricing out Fed cuts this year?
We are getting closer and closer to pricing out those Fed cuts, and I think we still have more to go. Look, in the short term, it has clearly weighed on the stock market already. I think that was definitely part of the dynamic yesterday. However, a scenario where yields are going higher because the economy is just too strong is not a negative environment for stocks. So overall, when we see yields go higher for positive economic reasons, ultimately, stocks will continue to go higher through that. They might just go higher in a more volatile fashion, but it is generally a good backdrop for stocks. It is not as good as a scenario where economic growth is strong and yields are falling, and that's what the Fed set us on in December, but it's still a positive scenario.
OK, and do we have to consider then, given the way you set it out there, Mark, do we need to consider which bit of the yield story is on the rise and the shape of the overall yield curve? I was reading some Ven Ram research, analysis on the Markets Live blog this morning, flagging that the 2-year, the yield there is not all that far from 5%. And could we test that today? Could we test that next week with the PCE data? What are you watching in terms of the shape of the yield curve?
Yeah, look, the yield curve, in the length of this inversion, already a record inversion for as long as we got records going back, has confused me for a while now. Maybe I'm the one who's been naive here because it's only when the yield curve re-steepens after inversion that you should start to worry about recession. So maybe this scenario of where we have a curve still inverted, then it's overall good for stocks. And that has generally been the history. During inversion, it's good for stocks. Now, the slight catch is it doesn't normally stay inverted for this long because inversion itself has an economic impact and should change how lending happens, which ultimately should provide a bit of a break in the economy. We're seeing no real sign of that yet. So all that is to say, at some point, I expect a pretty severe steepening, but there's no sign of it just yet, and I don't want to make the mistake of calling for it to happen imminently again.
All right, Mark, don't go anywhere. I want to kind of pivot a little bit from the bond market story to a little bit of the stock story, a little bit of the macro story. I want to bring it right back to NVIDIA. This is my obsession of the morning, or better put, perhaps a chart that caught my eye. We're talking about NVIDIA a lot lately, and just to put this kind of into context, the magnitude of the move, I want to bring you a chart that shows NVIDIA in the context of some of the biggest stock markets in the world. Now, that green line at the bottom is the NVIDIA stock price, of course. The white line is the German stock market, the market cap of the entire German stock market. In the blue line is the market cap of the entire South Korean stock market. Now, the reason I've picked these two stock markets to zoom in on in particular is because Germany, of course, is the one that NVIDIA is about to overtake. If you really zoom into that right side of the chart, you can really see it quite well that you are right on the cusp of making that ascension. But The South Korea story is interesting to me because I think about 33% of the Kospi index is just Samsung, not to mention some of the other chips players. It's one of the biggest chip exports. So you have to naturally compare it to NVIDIA, which is, of course, at its core, a chip company. Mark, I want to bring you back into the conversation here. When you look at a stock chart like this, I'm curious how much of this is, in your mind, driven by the fundamental NVIDIA AI story, as opposed to really just a liquidity story, given that 45% of their sales are provided by 4 of the largest tech companies in the U.S.
I think it's both aspects here. I think that there is a fundamental story and there's a liquidity story. These kind of size of companies or size of market caps relative to global context has kind of confused me for some while. You just take the US stock market, it's about 47-48% of global stock market cap. And that's when the US economy as a share of the global economy is less than half that, I'm pretty sure, as of the latest kind of reading. So it's around half that. And therefore, you kind of wonder, can US stocks continue to have this premium? And then we've now got the phenomenon of the last decade of where we get these certain stocks are really just so dominant, even within the US stock market, that they're really kind of controlling all the flows. So, but these are fundamentally strong companies. So to answer your question, Kriti, look, NVIDIA is expensive, but it's not as crazily priced on an earnings basis than many companies were in the dot-com bubble, or many of the more extreme cases. It's expensive, don't get me wrong. It seems like a bubble, but it's a bubble, it's just delivering. You know, so it's hard to kind of say this is a completely crazy pricing. And it's the same for those other massive companies in the US, whether it's Microsoft or Apple. These are companies which continue to churn out a lot of cash year after year. So fundamentally, it's not so distorted. But you're also right. As long as there are those cash cows and they have such big market cap, the rise of passive funds means they continue to attract more money, they continue to have a more entrenched advantage, and it becomes a self-feeding circular cycle. So it's both fundamentals and liquidity, which means they can continue to attract just extraordinary amounts of cash for much longer than people expect.
Mark, I love that you said I'm right like 3 times right there. It's just the ego boost I needed on this rainy Friday morning. Thank you so much. Bloomberg Markets Live Executive Editor Mark Cudmore joining us this morning. You get more from Mark and the team. Up-to-date analysis, of course, on MLIV Go, our Markets Live blog on the Bloomberg terminal. Let's go from the macro to the micro. Bring in Joe Easton from our equities team for your stocks to watch. Joe?
Morning, Kriti. So we got some positive news for GlaxoSmithKline out of an Illinois court last night. A jury over in Illinois saying that GSK and Boehringer weren't liable for an 89-year-old's cancer related to their Zantac anti-acid medicine, which has been a big weight on that company for a number of years. Now, the plaintiff sought $640 million in compensation, according to reports. And Jefferies today saying that it is a notable win, potentially removing a 10 to 15% share price overhang for this company this morning. So very positive, according to them. Now, we'll bring up the GlaxoSmithKline share price. This big drop here is where these Zantac court cases came to the front of concerns. It has kind of trimmed a lot of that, given they've settled a few cases. But this is another step in clearing this overhang for GSK, potentially a positive one for that one today. Then over in gambling, we've got a bit of a legal theme today, because there's also an update from Flutter. Now, this relates to the merger that created Flutter back in 2018. Now, some founders of FanDuel have been granted a Supreme Court hearing over the merger, where they alleged that they weren't given a fair price for their stake in the company when it merged with the Irish betting company Paddy Power, which we all know well. Now, the plaintiffs do actually allege that the board kept the price too low to avoid having to pay them too much. So that is what they say. However, FanDuel says the price was actually just a result of poor financial performance. They do dispute this, but it will go to court, potentially an issue for Flutter. But we can see that stock rallying since that merger took place. This is their push into US sports betting with American football, baseball, and all those other FanDuel sports as well. So that's been a big boost, but potentially a bit of a negative one on the legal front for them. Then over in paper and packaging, we've got Mondi. They've got earnings out today. They are looking pretty good. They're saying they're increasing some prices, and also their volumes are looking pretty strong as well for the company. The CEO, we've got the quote there, the market demand has continued to improve, increased selling prices across the business. Citigroup upgrading the earnings today. However, prices are 30% below the 2022 peak in the paper and packaging space. That was a pandemic overhang with all the online shopping, Amazon, all those boxes are made by companies like Mondi. It's had a bit of a wild run, given there was this long-running issue with the DS Smith takeover. Mondi was one of the companies that tried to take over DS Smith. And this, surprisingly, not really in a sector that gets the pulses racing, but the paper and packaging sector. Take a look at all these stocks. DS Smith was the target. Mondi tried to buy them. International Paper came in and says, actually, we want to buy them. That stock went higher. Then out of nowhere, Suzano out of Brazil came in and said, actually, we're going to buy International Paper. Upended the whole thing, made this crazy issue. And we've already had Smurfit doing a deal with WestRock in the US. So surprisingly, paper and packaging, one of the most interesting sectors in Europe this year. Keep an eye on those stocks today.
Joe, thank you very much indeed. If you want another interesting kind of story around the paper and packaging sector, Smurfit Kappa are making the beds for the Olympic athletes at the upcoming Olympics in Paris.
Out of paper?
Out of cardboard.
Out of cardboard. Amazing. Yep. I thought that was a daft question. Turns out it wasn't. No. Well, it kind of was, but wasn't. Wood Group, also in focus. Wood Group rejecting a 220 pence a share proposal from Sidara. This is, what, the third proposal from this company that they've rejected.
Yep. Let's talk a little bit about what's happening with Aberdeen as well. 2020... stock price kind of peaks, stock price goes down ever since then. Stephen Bird's been the CEO during that kind of entire period, or most of that entire period. He is now going to be stepping down, mutual agreement with the board. Jason Windsor's going to step in as an interim, but this is an asset manager that is looking for a new CEO. That could be one of the stocks we're also watching on the move this morning. 5 minutes to go until the start of trading here in Europe. Futures are negative. More details to follow. This is Bloomberg. 2 minutes to go till the start of trading this Friday. Here in Europe, we are going to be pricing in what we saw in the States yesterday to a certain extent. As the data came through, it became increasingly clear that we have a hot economy in the States, and as a result of which the Fed is going to be on hold for longer. We're now pricing just one cut out of the Federal Reserve this year. And as a result of which, equities went softer yesterday, and we are pricing that in this morning.
Yeah, absolutely, and we've got a few corporate stories to focus on, but it is a day really for the big picture, I suppose. And so we wait to see, just how negative things turn out to be here in Europe. But we do have these individual stories, and Kriti pointing out we failed to make the link between Aberdeen in the last part of the programme, so maybe we do that now. Aberdeen, the asset manager, in focus because of a change of leadership, and John Wood Group in focus. Yes. Based in Aberdeen, because of takeover activity. So there we are. We've put that straight. But interesting to see how Aberdeen opens. This is the asset manager. Stephen Bird was somebody who was he was trying to turn around the fortunes of this business, which had found itself really exposed to emerging markets. That was a strategy, but going back years, which hadn't played out very well.
But it was also part of this kind of this overall evolving story within asset management more broadly as to what is happening with pensions and how pensions are managed, and the groups that manage them, and the kind of the push as well to bigger and bigger groups, and they've been part of that narrative. Hargreaves Lansdown, interestingly enough, yesterday was up by 14%. On the back of all the takeover stories around that sector yesterday. So that was fascinating. National Grid, a little bit softer. What are we going to see this morning, I think, is an interesting question. Chip stocks. Nvidia did really well yesterday, but it may be actually that what we see this morning is some of the chip stocks here in Europe. Now, technology has been really strong recently, but some of the chip stocks today, you may see some weakness in that space here this morning, this Friday. Remember, we are also going into a long weekend here in the UK. That's a factor to think about just in terms of the flow narrative and the risk narrative. So it's Friday the 24th of May. We are open. Let's see what exactly happens here in Europe this morning to get an idea of what is going on. I already see AP Müller-Maersk a little stronger this morning, which I think is interesting. Mondi, we were mentioning just a moment ago with Joe. That stock looks like it's solid as well. I'm interested to see how National Grid trades on day two as a result of that heavily discounted rights issue. Could see some softness there again as well.
Yeah, that was certainly a story of yesterday, wasn't it? Real explanation of why we saw underperformance for some of the session from the London market. Quite a few upgrades and downgrades, and Joe talked to us about some of them, but I'm seeing Ryanair in focus on that front, plenty of Fortum in focus on that front, UK, home builders, all of that could move markets, so we watch Persimmon and Barclay as a result of those.
We should also talk about this from a sectoral perspective. You are seeing some of the commodities names on the back foot here when you look at the FTSE 100 in particular, Shell, Glencore, BP, all some of your biggest weights when you look at the index as well. Rio Tinto, for example, some of the metals companies as well, weighing the entire thing. National Grid, to your point, one of your biggest, in terms of index contribution, one of your biggest weights in those opening trades, down 9% this morning.
So over the last 2 days, it gapped lower yesterday morning on the back of the rights issue news, and it's gapped slightly lower again this morning, though it's still currently trading kind of above the session lows that we saw yesterday, but it's still down by 12% on a kind of Wednesday, Thursday, Friday basis. So it's interesting to see that that story is continuing this morning. We haven't talked a lot about the commodities, and I think that's a really interesting story. So oil prices have been down really sharply this week. That's been a theme that we've had to watch out for. It's interesting going into OPEC. I think OPEC's not next week, it's the week after. But commodities have come off the boil as well, really quite significantly. In the metal space, copper has come down really quite sharply. And maybe a sort of closing of that gap between the physical market and what's happening with the financial trade, and how those two maybe kind of resolve themselves will be really interesting.
And we'll talk a bit more about commodities later in the programme, won't we? We're going to be joined by Max Layton, Citigroup Global Head of Commodities Research. So we'll get into that conversation around copper, around energy. I'm also looking at technology stocks, a little weaker today, and I've got Mark's thoughts in mind earlier about, you know, when rates rise, they rise for a number of reasons, and if they're rising for good reason, you know, because growth is better than expected, and we saw that from US data yesterday, then you wonder what that does to expectations around stocks, and in particular the technology sector in focus, because it is so rate sensitive.
And that was kind of the divergence of 2023 versus 2024 in terms of the narrative, right? The 2023 is a very concentrated, tech-driven market. 2024 might be marking that change, and that it's far more of a broader rally, and that's a theme that we've heard from Beata Manthe over at Citigroup. It's something we heard from Sharon Bell over at Goldman. We also heard it yesterday from John Bell over at Newton Investment. He joined the program. Take a listen to what he had to say.
Breadth is key. So we run an income portfolio, not necessarily focused on small and mid caps, but we are interested in breadth because the market has been so concentrated, so driven by large cap stocks, particularly in the US, and very much with an emphasis on growth. We run an income fund, so it's almost a quality value type of portfolio, so nothing to do with what's been driving markets. And that breadth that is starting to come into markets is therefore very interesting to us.
Let's get another perspective here. Alex Stanish, head of global equities over at Artemis Investment Management, joins us this morning on the show. Thank you for coming in on a Friday morning, by the way.
Morning.
Braving the weather. Let's build on the breadth story here. It's been such a pillar of the growth you've seen in 2024. Does it stick around for the back half of the year?
Well, there are a lot of moving parts to that question. Obviously, you're seeing quite a distinction today. Just looking at the US market last night, you saw Nvidia was up pretty strongly in the back of its results. Actually, quite a lot of the rest of the market was selling off, especially in semiconductors. So you have quite a divergence happening between some of the winners and some of the losers. It would be very reasonable to expect more divergence to continue through the year.
One of the kind of pinpoints of NVIDIA from a micro basis, and I'll macro this out in just a moment, is that as a company, they're struggling to diversify, where almost half of their sales numbers are coming from your 5 biggest tech companies. So to me, at least on the surface, it feels like a very easy liquidity transfer, even that they're sitting on so much cash, your Amazons, your Microsofts, et cetera. When we talk about the diversification, is that the leading indicator then? When NVIDIA diversifies and the rest of the market will, is there that connection to be made?
It could be. I think one of the things you have to watch is if you look where the demand trends are happening. So clearly the hyperscalers have been spending very large sums of money on NVIDIA's equipment as they've scaled up not only data centers, but AI versions of data centers. If you look more broadly in some of the commentary from the CEO, they're talking about a broadening in demand, actually, from sovereigns, so governments building AI-powered data centers to some enterprises moving in here. So you're seeing a diversification of that spend from that incredible concentration and incredible amounts of money coming from the big hyperscalers. And that will continue to go up by all expectations, but that broadening out to other parts of industry is quite interesting.
So that's one big trend we watch, is that push into AI, and we've covered it a lot with NVIDIA and the like this week. We've also talked a lot about this National Grid story, where they are seeking to raise £6.8 billion in capital. We got the news yesterday, dropped the stock yesterday. It's dropping the stock again today. Away from the specifics of that business, though, this plays through another trend, which is all about electrification. Alex, at Artemis, is that something you're following and investing around? And if so, where do you think the profits sit within that process?
It's a great question. So the way we think about the AI trend at Artemis is there are effectively two waves of this. There's the first wave, which is the enablers. You're seeing that come through in the semiconductor companies like NVIDIA. There's a lot of spend going into those specific areas. But as that sort of, and again, power, getting even the copper wires. You were talking about commodities earlier on. You've seen the copper price has come back short term, but it's up very strongly on a slightly longer term perspective. So that's the sort of bow wave of the first wave of investments. But as you siphon through over multiple years, you'll see the adopters, companies taking advantage of some of these technological improvements to create better outcomes. Very, very diversified set of companies are taking advantage of some of the technology here. So it's sort of in two waves. First wave, get the stuff built, run the software, get the program, see what we can do. Second wave, how can we use this for our company, our business, to make things more efficient, more accurate as well?
And as you mentioned, so the first wave is semiconductors, and that takes us to commodities, and you mentioned copper. So where do you sit on commodities at this point then, given those transition metals have had such a strong run, coming down again now, but a strong run?
Yeah, I think, again, it's horses for courses. So you have to look at the specific demand-supply trends for each of the commodities. I think the one which has been called out would be copper. Long-term, the demand profile is pretty high, driven by utility spend, transmission spend. And that's not just from AI, remember. This is as you build a wind farm, an offshore wind farm, you need to plug that into the grid. There's a huge pent-up demand from that whole space, on top of the AI trends. If you look at, I think the IEA was forecasting US power consumption to go up, by 1.5% a year for the next many years, having been pretty flat since the GFC. So these things are changing. You're seeing changes in trends. We like the dynamic for copper in terms of the supply-demand balance. You can see the demand for that coming from the corporate side as well, with BHP trying to get hold of Anglos. There's a lot going on in this space. So we think copper looks pretty well set.
The tension in the market at the moment is between that AI trade and all the derivatives of it, we've just discussed many of them, and what is happening at the macro level, particularly with the Federal Reserve and the pricing out of rate cuts that we're seeing so far this year. Bostic was talking about this yesterday. He's talking about the idea that that the Fed is struggling to why we're not seeing policy having a bigger impact on the economy. And one of the factors behind that could be that financial conditions are very loose. The financial conditions was referenced in the minutes that we got earlier on this week. The Fed talks about the fact that a number of members noted the financial conditions were too easy. Financial conditions, when I hear financial conditions, I hear stock markets. So stock markets, financial conditions are too high. Stock markets, therefore, by extension, probably are too high. Is there a danger that we get into a position where we start seeing central bankers talking about this, particularly in the States, that the stock market is too optimistic at the moment, that the AI trade is driving these stocks to highs that are unjustified, maybe given the macro backdrop, and they need to slow this wealth effect down? How big a danger do you think that's going to be, and do you think that's something that investors should be becoming increasingly attuned to?
That's a complex question. I think how the wealth effect from the market affects different parts of society and different strata in society is very different, obviously.
Yep.
So if you think about that situation specifically in the US, where typically the wealthier portions of society benefit more from the market going up as opposed to the majority, that would counteract that argument slightly. But also, I think it's worth considering if you look at what's happening on the other side of the world. So you look at China, they're struggling to fight a deflation effect with the property market in some doldrums. So you've got an incredible spread of a difference in the economic conditions and inflation conditions, right away from China on one end, and then the US on the other, with a very resilient market. So you've got that spread, which does create some relief to the overall.
Can I come at it from a different angle? I know you're an equities guy, not a credit guy. There is a huge amount of dry powder sitting on the sidelines at the moment. There's too much sort of dry powder in the credit space, chasing too few assets in the credit space. The credit spreads are getting tighter and tighter. Financing conditions are getting easier and easier. Another factor that the Fed may be considering when it thinks about financial conditions. All of these speak to the idea, though, that the Fed is looking at this going, we've got to slow this train down. How do we slow this train down? And is that something, again, that asset markets more broadly need to be thinking about?
Again, it's a good question. So if you look at I think two things. One, you think a little bit back, longer term, about the incredible distortions we've had from through pre-pandemic into the pandemic, post-pandemic. The economic data we've seen from this period is highly unusual. It's very, very difficult to usually sort of say the traditional rule book and go, this is what we do. This is the lag effect from interest rate policy on the economy. We're seeing quite a few distortions with that. So it's maybe not clocking in a traditional cyclical way. It's a more extended cycle, and so the time for this to have an effect has stretched, especially in the US. You're seeing that resilience come through from PMIs, from employment data, and that creates a challenge for the Fed in terms of if they want to drop rates. But if you think where we've come from more short term, just before Christmas, we went from having a very low expectation of any rate cuts at all to suddenly pricing 6 in the market, which is an incredible overreaction. Clearly the benefit of hindsight, but even at the time, that's a big move. As we've gone through the year, that economic data and financial conditions has remained actually very robust. And so that's just pushed this timeline out. So it's extended the fade. Yep. The direction of travel still seems to be broadly the correct way, but the pace is obviously much slower than some would anticipate, leading to that sort of frustration you saw in the UK market just earlier this week when CPI data was a little higher, the FTSE came off. The opposite effect for bonds. So you have this just slow effect, which we still think direction of travel is working, but it's much slower than some commentators expected. That still seems to be tracking. Obviously, we're reviewing it constantly to see if there's any change to that gradient.
Alex, very quickly, for a brand new buyer in this market right now, is this the entry point? Are valuations relevant at the moment?
Valuations are always relevant. So if you look at the spectrum of global equities, there's again a huge spread between what's working, what's highly valued on a high multiple, and what's not. So I think there's a wealth of opportunity out there, but you have to dig a little deeper than just maybe some of the more exciting stocks that people know well. We see some tremendous valuations of equities. Just interestingly, just on a compete and a sort of an adject to this, if you look at the hype that Nvidia's garnering at the moment, and quite rightly, the results have been staggering. There are other businesses benefiting from this quite well. So Synopsys, which is one of the electronic design automation stocks, the software which actually makes the semiconductors, helps you design them. So critically for pushing power efficiency up, less power, you get more kind of output for your piece of silicon. Those things are working well in the background. They don't really get the same headlines, but those are sort of strong businesses working in the background, doing well. So if you find some opportunities off, or maybe a little bit off-piste, you can find some very interesting stocks.
Those derivative trades are really interesting. Alex, nice to see you. Thanks for stopping by to see us. Alex Stanich, Head of Global Equities at Artemis Investment Management, joining us here on set. Quick look at the core 6 around Europe, just to get an idea of what is happening with the bigger picture stocks that we watch every day to get a kind of sense of how the market is faring. And as you can see, plenty of red on the screen. This is we priced in the picture out of the States yesterday into the narrative here in Europe. Novo Nordisk, you could argue our version of Nvidia, maybe over here in Europe, maybe clocking a little bit higher this morning, up by just a tiny amount, but still with some green on the screen. Joe Easton's got you some utilities. Let's talk about what's happening there. Joe, over to you.
So we are going to start with utilities because we've actually got a bit of a profit warning out of Spain. Now, this is coming from Acciona Energías, and the stock is down 5%, and they are weighing on a bunch of peers today, including Nordex over in Germany. Now, analysts at Citi describing this warning as perplexing because they don't actually say how much the earnings are going to decline. It's a very vague statement, but it is weighing on the sector this morning. We're seeing those coming down. In terms of your UK renewables, we did get news of a reduction in the energy price cap in the UK here, heading into this general election. How will that have an effect on that? We're actually seeing Centrica, the owner of British Gas, and also SSE, which had earnings this week. Both of those are coming down this morning. Then in terms of healthcare, we mentioned GSK getting that favourable court ruling on Zantac, but that potentially priced in. We're not seeing too much of movement there. But one stock that is dropping is Philips. Now, this is on a recall. I've printed out the FDA comment on this. It's on their Omnilab ventilator. The FDA warning in a serious category that this may experience an interruption or loss of therapy and cause hypocarbia and potentially even death, the FDA is warning. So it's a very negative thing. They say it's the most dangerous of their warnings, and that is weighing on Philips. There has been an issue for that stock for a number of times, some of these recalls on that space. Then in terms of deals, there's lots going on. John Wood Group rebuffing another takeover. The UK engineering company is the focus of a foreign takeover. That one is rebuffed once again. Flutter coming down. There is an issue around some shareholders of FanDuel warning that they do want more cash from that former merger. Andy Bell of AJ Bell selling shares in his company, and they're down 4%. It's weighing on that. And Sasir in Spain. I was debating how to pronounce that, but a shareholder is selling a lot of stock in that, and we're down 6% on that one there. In terms of your cloud stocks, Workday in the US, a profit warning from them. The stock was down double digits, and we're seeing it weighing on SAP over in Germany this morning, taking the edge of that. Of course, the broader market is declining, as you mentioned. In terms of Maersk, Guy mentioned earlier, that is one of the best performers. I think this is related to Morgan Stanley upgrading their price target today. They say they're $7 billion above consensus on EBITDA because of the rising rates. Rates are up again. There's a story in the terminal about that in terms of the shipping rates. Finally, Ryanair going the other way. This one is downgraded over at Deutsche Bank now. Deutsche Bank warning that customers are starting to push back on higher prices when they travel. They say that this is something they expected to see, and we're all pushing back. We're not going to put up with it anymore. We're not going to take these higher prices, according to Deutsche Bank. Ryanair comes down 1.5%. They cut it to hold from buy, and it's declining over in Dublin.
Thanks very much, Joachim from our equities team with a full briefing on things on the move today. Coming up on the programme, it's change at the top for Aberdeen. We have spoken about this one. Joe's been talking about this story as well. We'll discuss why the CEO, Stephen Bird, is stepping down and the outlook for this business. This is Bloomberg.
Africa's most important election since the end of apartheid focuses on infrastructure challenges, economic growth, and political fragmentation. Bloomberg's Jennifer Zabasaja reports live from key battlegrounds in Johannesburg, Cape Town, and Durban.
We think that South Africa is an exciting part of the world.
South Africa is a thriving and vibrant democracy.
There's a lot of expectation for the election.
Coverage begins May 27th on Bloomberg Television. Context changes everything.
The CAAC has asked for additional validation on a lithium battery in that recorder. And because of that, we have not been delivering airplanes to China recently.
Brian West, the CFO over at Boeing, speaking at the Wolf Conference yesterday, talking about this idea that actually you're not going to see a step up in deliveries, particularly to China, because the Chinese authorities have signaled that they probably would like those deliveries to halt as a result. Concerns. It basically is around the battery that we use in the cockpit voice recorder. And the Chinese have some questions around that. What that is going to mean is that you are going to see this continuing strong cash burn coming out of Boeing as they can't basically monetize the aircraft they've already built by delivering them to China. That's when they get paid. And this stock got absolutely smashed yesterday. One of the big moves to the downside in terms of the US market was already under pressure, but Boeing was hit really hard on the back of this. There's been some semblance of signs maybe that actually we are going to see some delivery options increasing, but that's not going to happen in the next quarter.
Weighed on the Dow yesterday, I read, Guy, which I'm sure
we should ignore the Dow, but anyway.
we really can't ignore the Dow.
We were having this conversation while you were in
Pretty
Spain,
wants another
Chrissy.
hat.
Anyway.
I do. I want the Dow 40,000 hat, and I can't seem to source one at the moment.
Well, maybe just give it time. Maybe there'll be another number, big
Dow 50,000, 100,000.
That feels better. 50,000. Wow, that would be.
Then you'll care about the Dow.
Yeah.
No,
let's not go that far.
Not even then.
Oh, my goodness.
Talking of things shooting higher.
Yes, of things that are flying high. There's a lovely story on the Bloomberg terminal about SpaceX and how you can potentially maybe get a share of the action here. And this is coming from a liquidity round. And I think around all of the excitement around SpaceX, you can't actually access it. This is not a publicly listed company. This is one of Elon Musk's many, many projects, of course. Value to get this $200 billion. It's the valuation here that's catching a lot of attention because they do these tender offers where basically employees of SpaceX can throw out their stock if they need to, the access that they have. They usually offer at about $108 to $110 a piece for this round of tender offer. It happens every about 6 months or so to kind of keep it going. $108 to $110, very accessible, much more accessible for the average retail investor than, say, a $1,000 NVIDIA share, for example. But the valuation is interesting. $200 billion, when 6 months ago it was just $180.
So I instantly asked our colleague Daniel Curtis, where would that put it? If it were listed, what would be its comparably sized businesses.
We love a little size and scope at Bloomberg.
Exactly. So it would be like Disney, McDonald's, T-Mobile. These businesses are similarly valued to that 200 billion. In fact, they are a little smaller than what would be listed SpaceX if it were to be listed. It would be the 41st largest US domiciled company.
And we think about the fact that Nvidia is now bigger than the German stock market. It's an entirety. These are big numbers, and in size and scope, huge in comparison with some of the European stocks.
Yes, this is the size and scope that I'm sure our viewers tune in for. Let's hope so. Let's move on to other matters financial. Stephen Bird, the chief executive of troubled asset manager Aberdeen, has stepped down. The CFO, Jason Windsor, will become the interim CEO, and the firm will start a formal search process that will also consider external candidates. We're joined by Bloomberg's Tom Metcalf, who's been poring over the detail of this story. And Tom, so I said they're troubled asset manager, did I? I mean, take us back a little. What's the backstory here?
Yeah, I mean, look, he inherited a tough hand, right? You know, asset managers, particularly mid-sized ones like Aberdeen, you know, they really are sort of in the middle of nowhere right now. So there's that move to passive investment, and of course, then you need to scale in this business. So it's been a tough ride for him. And I think, I can understand why they probably made this decision. They're maybe looking for a fresh injection after 3.5 years. And interesting that, this CFO, James Windsor, it looks like he's going to probably take over if he's been made interim CEO. But yeah, it's one of those ones where it's hard to see, how much difference could he have made against, this huge backdrop of sort of industry-wide difficulties. And for me, I think the big message here is just what a tough spot asset managers like Aberdeen
It confirms that tough spot. Is this also, we're seeing consolidation in this sector more broadly. Is this another indication that maybe this is a company which was created in so many ways out of M&A anyway, that we now need to see another deal being done? Is that what the new, be it Windsor or be it somebody else, ultimately is being brought in to do?
Yeah, I think that's ultimately probably the most obvious sort of exit out of their predicament, I would say. But the difficulty is they've had about 6 years of outflows. It's not like people are lining up to pick this one up because precisely for those reasons, it's not that much as attractive a business as it once was.
So the business itself is tough, but Stephen Bird as well wasn't necessarily popular right off the bat internally. I think one of his first moves was to get rid of bonuses for a lot of his folks.
Yeah, no, exactly. He had to take a lot of tough decisions, and I think, we did a piece a year or two ago kind of looking at just sort of the atmosphere in the company, and it has never it's never felt like that company is a happy place necessarily in recent years. And then, of course, it was that famous rebrand where they knocked all the vowels out of the name.
I was just going to say, is that going to be the answer, Tom? I mean, do they just need to bring back the vowels?
Bring back the vowels. I mean, as an editor, I certainly like the vowels back because it still trips me up. But, I mean, it's funny to say, but I do think that's one of the things that people remember of this time. It's
one of the first things that went through my head when I saw the headline this morning, so I apologise for that. Tom, thank you very much. Thanks for joining us. Bloomberg's Tom Metcalf with the latest on the financial services sector more broadly and what we're seeing specifically at Aberdeen. Coming up, we will talk commodities. We've been mentioning this throughout the programme. Copper is headed for its biggest weekly loss in more than 3 months. The backstory, though, has been very elevated copper prices. So we'll get to both of those themes. Where do we head next on the copper price? We'll talk about other commodities as well. We're going to be joined by, for a really good conversation around the copper market and the broader commodity space. Max Layton, Citigroup Global Head of Commodities Research, will be with us shortly. This is Bloomberg.
This is Marks Today. We're about 30 minutes into the European trading day. Sentiment is pretty low when you look at the equity markets. Your Stoxx 50 down about 0.7%, similar margin for the FTSE 100. It's also sentiment that I would argue is bleeding into the commodity space as well. Copper, for example, on the back foot, down about 0.2%. Oil as well. Gold outperforming, but it is the only metal green on the screen right now. But let's zoom into that metal story because copper, even though perhaps down only a little bit this morning, it is headed for its biggest weekly loss in more than 3 months. This, of course, coming as a strong dollar, the weak demand in China, all taking its toll. It also comes if you saw a big bump in the prices. Let's get a little bit more context here. Max Layton, Global Head of Commodities Research over at Citigroup, joins us this morning. We were just talking about a short squeeze in copper, and now we're seeing this kind of correction, mini correction almost. Walk us through the copper story, your initial views on where copper's going next.
Sure, yeah. Pleasure to be here. Thanks for having me. Look, on the copper side, it's been a fantastic run. It's had a fantastic run, and now I think all we're doing is we're kind of consolidating up here at levels which, frankly, according to my equity colleagues, equity markets were already pricing in these kinds of prices 3, 4, 5 months ago before the commodity rally. So I guess you could say all that's really happened is the commodity is caught up with the long-term bull story.
Is the commodity story, copper specifically, I'm really macroing this out. Guy and Anna can nerd out about the inner workings of the metal space. Is copper and its commodities, is it still a risk gauge when in terms of global growth, et cetera, or is this still a question of physical shortages, contracts that are splitting between London and Shanghai? How are you thinking about it?
Sure, yeah. I mean, I think 20 years ago, copper was trading its end-use markets. It was much more physical commodity. Nowadays, it can trade whatever investors think it's worth. It's very inelastic on the demand and supply side to price. And so it has these kind of quasi-equity-like characteristics now that you just don't see in oil. It's a 10 to 15 times smaller commodity market where, we've seen $40 billion of long positioning come in, equal to 10 to 15% of annual consumption. And this is what drives price in the short run.
Can I turn to what's happening with the energy markets?
Of course, yeah.
Oil's down pretty sharply this week. They've got an OPEC meeting, not next week, the week after. Is that the next big event? Will that OPEC meeting stabilise prices? We're going into the driving season as well. I would have normally thought that the driving season in the States, start on Memorial Day, will be something that will be positive for prices too.
Sure, yeah. Look, short run, we're broadly neutral. We think OPEC Plus rolls forward the cuts. But, I can see almost like an inverse copper trade over the next 6 to 18 months, to the downside on oil. We're very similar, but, the inverse sign. So oil has a lot of spare capacity. Copper has no spare capacity. Oil has a lot of broad-based supply growth, low-cost supply growth. Copper has practically none over the next couple of years. And, they're both have very different exposures to the energy transition. Particularly China's aggressive push on the energy transition. It's bearish for oil at the margin. It means oil's beta to cyclical growth is lower and copper is higher. So I think, 6 to 9 months ago, it was very difficult for people to put on the copper bull trade because they were worried about some downside risks in the short run. And it's the same thing the other way around in oil. People are worried about driving season in terms of being bearish on a 6, 12, 18-month view on the structural dynamics in oil. They're worried about driving season, short run, hurricane season. You've got, obviously, Middle East conflict, Russia, Ukraine conflict. But ultimately, we're seeing prices averaging $60 next year. So it's...
Wow, OK.
It's...
Does that mean that the gas price, which I've seen ticking up recently, starts to reverse as well? There's a sort of strong degree of correlation there, because at the moment what I'm seeing is gas prices going higher, certainly here in Europe, and that's been a story over the last few weeks. It comes also on a day when we've seen energy prices here in the UK be marked lower by Ofgem, and I'm wondering whether that trend is going to be petering out. If you think the oil price is rolling over, does the gas price roll over with it?
Sure. Yeah, I mean, there's certainly potential over the next 12 to 24 months for like a broader BTU surplus, and we're investigating that at the moment. I mean, short-run gas, there was some big major production cuts in the US, and they're really tightening up the balances. Henry Hub up 50%. In terms of outlook, broadly neutral on gas from here. We think this is going to encourage, these higher prices that we have now are going to encourage some restarts in the US. I think a lot of clients are interested in the risks around the pipeline gas through the Ukraine over the next couple of months with the contract expiry, and that's that's going to support prices up at these levels, but maybe not enough to really absorb all the extra supply we're probably going to see from the US.
Can I ask you, Max, about FX markets and the dollar and the role of the dollar here? I was reading some research by Bloomberg Intelligence saying that platinum, copper, silver, these are the metals that have the strongest negative correlation in their view, or by, thanks to their analysis, to the dollar. What is your expectation there? Because that takes us into, FOMC, Fed expectations, what the dollar does. How much are you thinking about that?
Yeah, we're certainly thinking about that. The House view is quite out of consensus in terms of Citi Research's House view. We've got 5 Fed cuts this year, lower real rates into the end of the year, early next year. And that's certainly going to be, we think, the backbone of the next move higher in gold, right? So, gold's probably the one that we think is most leveraged to that out of consensus view. We've got it going to $3,000 over the next 12 months.
So oil lower, gold higher. 5 cuts and the market is only pricing in 1 right now. Where does that leave gold? And I was going to come on to talk to you about gold prices.
Yeah, I mean, it certainly would make us less bullish, but I I mean, the underlying drivers of gold are very physical at the moment, so we feel like the support for these gold prices, obviously gold's broken the relationship with real rates of late, and that's been all about colossal Chinese retail demand. I mean, off the charts. And China's, like, in my career, I've never seen China on the bid at the highs, and the dollar notional that they're putting into gold is, we ballparked it, it's roughly 40 to 50% of what would have otherwise gone into property. There's a big shift from property spending into gold in retail in China. It mopped up about 2/3 of ex-China mine supply in the last 3-4 months. So, really absorbing all the mine supply, that plus the central bank demand, and there's nothing left for the jewellery market.
And just I know Kriti's coming in, but does that change, that dynamic in China around gold? Does that change? Do you see anything that changes that?
Yeah, I mean, that is the biggest downside risk to gold for us, is that ultimately the government controls the quotas on the imports, and I mean, the imports aren't necessarily, the quotas aren't published, and they could dry up if the government becomes unhappy with the transfer of wealth from perhaps consumption and retail into physical gold.
So what's the way to invest in gold then right now? If I'm an investor looking at gold as potentially that central bank hedge or whatever your bull case might be, do you do it with the physical demand? Do you call your folks in Asia and say, let's stock up, or do you do it via the liquid ETF markets of the States? How do you access it? How do you get to it?
Sure. I mean, there's equities, ETF, the commodity.
Sure, but what's the most lucrative
Yeah, I mean, CFTC. I always worry about getting these questions because I can only answer on the commodity side. I'm not allowed to give a call on equities. Certainly not allowed to talk about ETFs. But look, on the commodity side, we've got. I mean, I would say overall the action in commodities has been almost 95 to 99% copper from a client activity perspective, from what I hear about and I see. It's not so much been in gold. I think there's a lot of room for gold. I mean, frankly, many people, including ourselves, were scratching our heads as to what the new drivers were, and now they've become clear that it's China. I think we're going to get a lot more interest in gold because people can kind of get their heads around it.
Can I just come back to the China story and the housing story? Every time I see a headline, therefore, that the Chinese government is trying to resuscitate the housing market by delivering significant stimulus into that space, should I assume that I'm selling gold? If the housing market recovers in China, is that a negative for the gold price?
Sure. Yeah, so we've done a lot of thinking about that. I mean, it's coming off a low level. So, I mean, essentially there's excess savings in the country, and property sales are off between 20 and 30%, depending on the measures you look at in the primary market. I would say the recovery in housing would not take the heat out of the gold physical. And the reason is because it's not just about the property weakness. That's a reallocate, part of where the capital's kind of come from or been released from. But it's really about extremely poor sentiment from households and from the private sector generally about the economic outlook in China. And that's probably not changing. That's been something that we've been talking about for a couple of years now.
You mentioned that most of the conversation with clients is around copper, or you had some lines around that, Max. Does that mean that other metals that are transition metals also are being overlooked at this point? Are there opportunities in others?
Sure. Perhaps not overlooked, but I mean, the rest of the metal space has had a kind of a machine-computer CTA correlation and rally with the copper rally. I just don't think humans have really participated or got involved in that. I mean, there's other opportunities which have certainly got our clients really excited. Like, for example, lithium has a super outsized contango in its hydroxide market that we put out a couple.
Now you're talking.
I was about to say, let's get into the nerdy.
Super outside contango.
Yeah, I mean, like 30 to 50% upside in trade recommendations we're putting out the last few months, and they're up 10% so far, 3 or 4 weeks. So it's
okay. One final quick question for me. These guys are going to get. Oh, the producer will probably get cross with me. Does volatility in commodities continue? Because the trading houses are making bucket loads right now, and just in terms of the volatility.
Sure. Jan, Feb, there was no vol. All of a sudden, March, April, huge vol in copper.
Yeah.
Vol in oil is at 10-year lows, around 10-year lows. So copper vol will come off and vol will settle down a bit.
Okay, Max, nice to see you.
Thanks.
Great to see you on a Friday. Max Layton, Global Head of Commodities, joining us from Citigroup. Really interesting to see what the trades are going to be around all of this. If the copper story rolls off, Do I read that as a macro story? I think the housing connection with China,
Yes.
China's just dominated that gold story.
We're getting some data out of China next week, so, you know, that'll be something certainly to watch. The fate of the Chinese economy, it gets everywhere. You know, we'll be talking about it for European corporates. We can also talk about it for commodities, though, and gold.
Can I make a really nerdy connection here? We're talking about China. The copper, even the lithium story, that's also a Chilean story as well. There is a EM, South American trade built into that as well. I don't even have time to go into my favorite kind of commodities chart, which is Tesla and cobalt pricing, but for another day.
We'll save that for another day.
Yeah,
that sounds exciting.
You can do it next week.
We'll park that one.
Yes, when you guys aren't here and I have all the time to talk about it.
Right. The SEC has paved the way for the launch of the first US exchange-traded fund investing directly in Ether, the second biggest crypto asset. Let's get to the details. Bloomberg Daybreak Europe anchor Tom McKenzie has been delving into the details of this story and joins us now. Tom, how significant is this then? What do we need to know here?
It's a really big deal in the crypto markets. There's a lot of excitement about this. You'll remember, of course, when the spot Bitcoin ETFs were approved after a lot of pressure on the SEC, legal pressure. They finally, reluctantly, through gritted teeth, approved those exchange-traded products, spot Bitcoin, and of course you saw these massive flows into some of these products held and created by the likes of Fidelity, BlackRock and a number of others. So what they're hoping within the crypto space is that you'll see a similar kind of flow into ETFs backed by spot Ether. We're not there yet. We don't have a time frame exactly as to when this could get to a final approval, but clearly it's a significant step. They've taken one step, the SEC, an important step in terms of getting to the point where they could be finally approved. Part of the debate now is whether or not they land on this is a security or this is a commodity, and of course those within the crypto space want this to be labelled a commodity, something you invest in, rather than a security. There's all sorts of other legal implications if they come down on the security decision. But so far, it's a major step forward for those in the crypto space.
So commodity ETFs are famously very hit or miss. GLD works very well. Diamond ETFs, for example, famously do not. When it comes to the volatility story, could this, as a passive investment vehicle, then calm down the crazy volatility, the crazy swings you see in Ether?
Well, when you look at Bitcoin, it's been relatively stable. It broke above that 70,000 record level. There's some pressure coming through in terms of the Fed cut narrative on that. So I think that probably the jury's still out. Certainly those within the space would make the point and they would argue that you would reduce volatility, that you have institutional players putting together these products. The concern clearly for the SEC all this time has been that you are exposing an ever larger slice of the retail and institutional investor base in the US to a product that isn't inherently risky, that's all that legacy about you being used for money laundering and cybercrime and all that kind of thing. That's been a question mark still for the SEC, and they lost these court cases and were compelled to offer these products.
Institutional investors, let's assume they've assigned all they're going to assign to crypto as a result of the Bitcoin move that we've already seen. Is this a zero-sum game, i.e. if Ether comes in, does Bitcoin lose out because just the totality of the number doesn't increase?
Yeah, that's a really valid question, isn't it? To what extent does Ether offer you something different that Bitcoin doesn't? It's got the blockchain capabilities and underpinnings that are different to Bitcoin, and something that the proponents of Ether say makes it very distinct from Bitcoin. It's an architecture that can be more easily implemented for all sorts of different use cases. So if you're lifting the lid and getting all granular, then that's maybe where you make the distinction. But to your point, if you're a regular retail investor or an institutional investor, you just want 5% or 2% exposed to crypto. Does it really make a difference? Does that really start to play out? I think that's a really valid point, and we should start to watch that once and if, of course, they get approved.
And if higher for longer is the narrative around broader markets, then what that does to crypto is also something we watch. Thanks very much, Tom. Thanks for joining us. Bloomberg Daybreak Europe anchor Tom McKenzie breaking down the Ether story, the latest in the crypto narrative. Coming up on this programme then, a two-speed global economy is the elephant in the room, it seems, at the G7 finance ministers for those ministers as they gather in Italy. We are live there next. This is Bloomberg.
This is NATO's eastern line of defense. Tensions are running high, and here in the Baltic states, the military alliance is building an advanced presence. to counter one country.
Russia have the intention to trust NATO, and it's a question how much opportunities we will give them.
While troops on the ground are a big statement, there is a number behind the scenes that's far more significant.
2%. 2%. 2%. 2%.
That's the share of their economic output that NATO members committed to spend on defense. But for a while, countries didn't get anywhere near that number. And under multiple administrations, the US hasn't been happy about it.
They said, well, if we don't pay, are you still going to protect us? I said, absolutely not.
The threat from Russia means that is starting to change.
We have no time. We have to be prepared as fast as possible.
Now, some are asking if 2% is even enough.
NATO spending a big theme right now, and Europe is playing catch up. How does it finance it? How does it deliver it? How does it make sure the industrial base is capable of providing the weapons that Europe now so desperately needs, it seems? And how, at the same time, do we continue to finance what is happening in Ukraine? That is a big subject, certainly for the G7 finance ministers. They are gathering in Italy today. Ollie Crook is monitoring events. Ollie, let's start off with this issue of how we continue to finance the Ukrainian conflict, how the West, how Europe provides funds for the Ukrainians. This is a big subject, and it does seem as if we're starting to coalesce around some clear ideas about particularly how we use Russian assets to be part of that puzzle. Talk us through the argument and how it's developing.
Yeah, that's right, Guy. That really is kind of the main deliverable, I think, that the G7 finance ministers want to leave this meeting here in Stresa, Italy with, which is basically what is the architecture for monetizing these Russian assets in a way that is internationally compliant with law, but also hefty enough to make a difference and really get the financing for the Ukrainian war effort on sound footing, not just for this year, but for the years to come. And so the question initially was, shall we seize the underlying assets? That was the U.S.'s plan. The Europeans say, hey, that's a little bit too rich for us. But what we'd be open to, and this is the U.S. plan, is monetizing the future profits of those assets and maybe cutting a check in the next couple of months for about $50 billion. That's where the conversation has sort of coalesced. Where it's reaching some difficulties is who is going to sort of back those dollars and that money if, say, you have a peace treaty that is signed in 5 years and you've sort of you've promised the profits for the next 15 years, who's going to write that check? So these are a lot of the technical questions that are behind this. But for the G7, it's really important for them to come up with a decision here because, as Janet Yellen said yesterday, Putin is waging a war of attrition. And if the G7 can't get it together and really prove their commitment there, then Ukraine is going to be in big trouble.
Ollie, where does China stand in all of this?
So what's interesting is Yellen made it very clear yesterday. She wants China and the trade practices to be a really sort of central role in the conversation here. And just a few minutes ago, we were just speaking with Bruno Le Maire, the French finance minister, who echoed some of the same sentiments. Have a listen to what he had to say.
We should definitely avoid any kind of trade war, because a trade war is neither in the interest of the US, nor China, nor Europe, nor any country in the world. But nevertheless, we have an issue with the unfair trade practices, with the high level of subsidies, and with the industrial overcapacities. I'm the Minister of Finance. I'm also the Minister in charge of economy. And I will spare no effort to defend our industrial interests.
So you had a little bit of hedged language there from the French finance minister, but the message pretty clear and unified for the G7 that the Chinese unfair trade practices will not stand. But I asked him in that meeting, listen, the United States throws up these trade barriers. They do it very fast. All of that overcapacity that they're trying to address then often shifts over to Europe. How do you address that? Do you need to come up with a G7 solution to that problem and be more unified? And one of the things that we got out of there that we need to chase a little bit more detail on is that they've apparently tasked the IMF with coming up with a report to look at how the Chinese trade practices are affecting the global economy. So that's something that we're also going to be chasing while we're here.
Thanks so much, Ollie. Bloomberg's Oliver Crook with a briefing from that G7 event in Italy. Thank you very much for joining us. All of that working up towards the G7 leaders event, which comes in June. So this is the finance element. We will be there, of course, conducting interviews for you at this finance meeting of the G7, including with Paolo Gentilonni, the European Economy Commissioner, plus an exclusive conversation with Joachim Nagel, the Bundesbank president and ECB Governing Council member.
Of course, we're going to have full coverage there. Ollie really leading the charge there. So we're going to get those headlines throughout the rest of the day. But there's also some data that we want to keep an eye on as well. At about 1:30 p.m. UK time, we get that U.S. durable goods data. We're talking about factory orders, talking about manufacturing story in the States. This is going to be one more data point that we've got our eye on. We've also got AGMs as well when it comes to Total Energies, I'm going to say that right, Amundi, and a couple of others as well. So you want to keep an eye out on the stock-specific story as well. But central bank speakers are also going to really shape the narrative. The macro versus the micro seems to be a really interesting kind of tug of war here, as Anna was talking about earlier in the show. Schnabel, Jordan, Waller, we get lots of voices from around the world. Plus, of course, those sovereign rating updates. Always fun for those folks staying up in the States on a Friday night.
Yeah, just a little bit of a last-minute kicker, maybe.
Yeah.
It very rarely produces a surprise. Very rarely, even if it does produce a surprise, produces a big market reaction. Next week is interesting. Next week is about PCE. Next week is about us back to this inflation narrative. And there's been certain elements of the data we've seen over the last few days that maybe point us to the fact that that number is going to be maybe problematic and is going to further confirm this idea that the Fed is stuck and is not going to be moving anytime soon.
Yeah.
And I wonder how much more pricing out of rate cuts we're going to see this year.
Yeah, and I wonder what role the PCE will play in this conversation, because I was looking at the estimates on the Bloomberg terminal, actually, and we're not expecting much of a move in PCE. No. It's sort of stuck at 2.7%. If you're looking at the PCE deflator, of course, year on year, the month-on-month number, expected to stay stuck at 0.3%. This bit of data, if things stay as they are now, this bit of data will drop into a market that's busy pricing out rate cuts from the Fed and unmoved inflation data. I wonder then how that lands.
Well, this bond market, in addition to the data, is very sanguine as well, because we don't really know what the narrative really is, because we start every Monday, it feels like for the last couple of weeks / months, saying, look at all this Fed speak we have, look at all this commentary, all this data. The markets move, and then we end on Friday exactly where, at the exact levels that we started the week off. You can see it today, for example, with the 10-year yield. How much different changes did we get from the FOMC minutes, from the bond story, even the read-through from NVIDIA into cross-asset? And yet, net-net, the 10-year yield still 446.
We should just do programs on Mondays and Fridays then, maybe.
I think so.
Yeah, that's
but Monday the Americans are closed. Yep. It is Memorial Day. We're closed here in the UK as well. We get the holiday that everybody else got in Europe last week. It's a big weekend of sport coming up as well, just to...
Are you just going to brag for the last 30 seconds of the show?
Exactly, yeah. All of these things are happening. Manchester's basically coming to Liverpool this weekend. We've got some great tennis that's going to be on too. It's a long weekend coming up. Not for Kriti, but for some of us.
I'm going to be working like a normal person.
We are very happy that you're able to do that. Kriti will be back with you next week. That is it for Markets Today. The Pulse is up next. Markets are weaker. This is Bloomberg.